Investing has all sorts of potential options, and there are almost endless ways of making money within investing. And so a big component of that is actually bonds. Now, a lot of people maybe have heard the term bonds, but there's really a lot of confusion I find in your average investor, average person, planning for retirement, or if they're working at Disney or wherever. Bonds really just are not that well understood, probably because the media just doesn't really cover bonds that much. I mean, with the Fed interest rate hikes and stuff, that's been covered a little bit more. But in general, I find people really have no idea how bonds work, what they are, or how you would even use them in a portfolio, even if people own them. And so I want to just spend a minute here to go over a few different thoughts when it comes to bonds. The first thing is, what is a bond? And a bond is it's a form of investment security, but in essence, you are when you buy a bond, you're loaning money to a government or to a corporation, and there's terms associated with that. So generally, you'll loan the money for a 5 year period or a 10-year period. They'll pay you an interest rate along the way, and at the end of that 10-year period, they're going to give you your money back. So, for instance, if there was a company that wanted to build a building, and it's going to cost them way more money than they have in cash. It may cost more money than a bank is able to loan them. So what they do is they create a bond offering, and this is basically the terms of the loan agreement. And rather than borrowing the money from one bank, they open it up to investors across the globe, and 1,000 people or 1,000,000 people or however many people buy these bonds. And typically they're issued in $1,000 increments, but they may buy $10,000 worth of bonds. A lot of times, pensions and foundations are really big bond buyers because they have to be fairly conservative in their investment approach. And bonds, they have that stated interest rate as far as earnings go, and so they're attractive to those type of investors. And so, that company will raise the money through a bond offering, and you as an end investor, you have a contract with that company for that term, and they're agreeing to pay you interest along the way, and then pay you your money back at the end of that 10-year term. Now, if it's a company, it's only as good as that company's ability to pay. So that's something certainly to be thinking about. So that's what a bond is, how it works. So what are the potential returns with bonds? Well, really the simplicity of it is in essence the interest rate that you're signing up for the loan. Interest rates have come up much higher now in 2023, so where the 10-year treasury yield is around 4.25% depending on the day. And so that has caused interest rates overall to be much higher, which is great, unless you have a bond from 2021, 2020, 2018. Those returns were much smaller back then because we were in a lower interest rate environment. So that's if you have a new issue bond. The only really calculation that you have to understand is what is the interest rate that they're paying you for the time frame. Now, when it comes to bonds, there is a secondary market. So that means there are other people out there that maybe don't want the bond for whatever reason. Maybe they need the cash, or they want to go buy some other investment. Whatever the reason is, they want to sell the bond in the open market. Well, depending on what the interest rate is, and the company and the risk and all that stuff, that bond could either be at a premium or a discount of what it originally was offered at. And so that then could go into your potential returns. If it's at a discount, let's say that it was a bond that was issued at $1,000, but maybe it's now worth $990 because of where the market is and everything. If you buy it below there, then you're going to have some appreciation, and you're going to have the interest that's paid along the way. So there can be decent returns in bonds. Typically, on average, over history, bonds have returned lower returns than stocks, but that's mainly because it takes a lot of the risk out of investing, as far as the volatility of the market, because again, a bond, if you own it, as long as that company stays solvent, you get your money returned back at the end of the period. And not only are you able to loan companies money, but you can also the U.S. government bonds, a lot of local city, state government bonds as well, called municipal bonds. And so the returns generally are not as strong as other investment classes, but their bonds generally are also not as volatile. So that brings up, what are the risks? The third thing to be thinking of: what are the risks when you're investing with bonds? Well, certainly bonds are heavily impacted by the interest rate environment that we're in. So if interest rates go up, bond prices will go down. Typically, that's not always going to happen because there's more to it than that. But if interest rates are going up, that means that a bond that's issued today is going to pay a higher interest rate than a bond that was issued maybe 3 years ago. And so that bond that is issued 3 years ago, for that person to be able to sell it, to be competitive for me as a buyer, they'll have to discount the value of their price to make it competitive with what I can earn on a bond that's being issued right now. And so that's why we have that inverse relationship between interest rates and prices. And so we saw that heavily in 2022. 2022 was one of the worst years for bonds, going back to like the 1600s. And so, so there's that risk. The other risk with a bond is it's guaranteed by the issuer that's offering it. So that company has to be around to pay you for you to get your money back. And while there are certainly companies and governments that are very have very strong balance sheets, there are also lots out there that don't. And so there is a very real risk of loss of principal in bonds if the issuer that issues the bond goes bankrupt or is unable to pay. So those are the two main risks with bonds. Certainly other things like a reinvestment risk as well. So if you've bought a bond and it matures, if interest rates have come back down, then you're going to get a lower interest rate than had you bought a longer term bond, things of that nature as well. So the fourth thing is, how do we evaluate which bond to buy? Well, there's a lot of different metrics. Typically, what we're looking at is who is the issuer, what's their credit worthiness, and how much risk are you willing to take as an investor? Do you want to lean or use only high quality governments and companies to mitigate the risk of your loan going defunct? Or are you really trying to get a higher yield and you're willing to take on some risk that maybe the bond that you're investing in, or bonds hopefully that you're investing in, maybe would go out of business? So we want to understand what's the credit worthiness of the issuer. We also want to understand what are your needs as an investor. Is there a certain time frame when you need that money? Is there a certain income that you're trying to get? Are there tax ramifications? Because a municipal bond has the potential to pay tax-free income, where a corporate bond is going to be taxed at ordinary income. So that has an impact on which way to go with bond investing. And certainly we want to evaluate your ability to diversify your portfolio. Generally, we don't want to have just one bond in the portfolio. You probably want many to mitigate some of the risks associated with having just with one bond. And the fifth thing is, then how do you apply it? Okay, what do we do now that we know what a bond is and some of the risks, some of the returns potential, some of the how to evaluate it? Well, whenever we're investing within a portfolio, again, it goes back to what's your situation, what are you trying to accomplish, when do you need the money by, what's your ideal rate of return to achieve the goals and objectives that you have. With all of that said, though, generally we also want to look at what type of account are you investing in. Is it a non-retirement account, or is it a retirement account? That's also going to have some impact there. And what does the rest of the portfolio look like? Are you wanting to invest just solely in bonds, or do you have some other assets in there? Maybe you have some US stock, some international stock, some mutual funds, some ETFs, or what have you, annuities. There's all different sorts of things. So the bonds play typically a role within the larger portfolio. And And perhaps you want to look at not only maybe not owning an individual bond, because the risk, again, the main risk with an individual bond, or one of the main risks, is that it could go bankrupt. So you could access mutual fund or exchange traded fund bonds through a mutual fund or exchange traded fund. The risk with those, though, are that you then potentially lose your maturity date, which is one of the main benefits of a bond. So you trade off the benefit of a specific maturity date, which reduces the volatility of the bond, or expected volatility of the bond, but it gives you greater diversification where the risk of one of those bonds going bankrupt is mitigated, or that if it does go bankrupt, it's not going to hurt your overall portfolio drastically as much as it would if you owned the individual bond yourself.